Hey everyone, how's it going? It's Dan Russo, Chief Market Strategist at Chaikin Analytics, coming to you on a Friday morning pre-open. It's about 9 a.m. here. I just wanted to highlight some things that are on my radar screen as we finish out the week. Some of the things that I highlighted in my note today that I think are important for what's going on this week. First, just a quick recap. Big backup in rates as treasuries have sold off has caused a little bit of a tantrum in certain pockets of the equity market, in particular the high multiple growth stocks within the equity market. Now, we've talked from time to time about what this means and why that is, so I'm not going to rehash that here. What's interesting to understand is the rotation out of growth, in particular mega cap growth, and into some of the more cyclical areas of the stock market has been playing out since September. Okay, this is not a new phenomena this week or over the past 2 weeks. This is a trend that's been in place for months. And that's number one. Number two, treasuries have fallen to a point where it makes sense to look for them to bounce here. In particular, you can see the chart behind me is IEF, that is the 7 to 10 year treasury bond fund, has pulled back now and actually yesterday traded at the levels that we last saw in March, the March lows. What's interesting about that level is that it lines up with some highs that we saw back in 2019 as well as 2016. The fund right now in the near term, based on our overbought, oversold indicator, is oversold. Now, it's been a very bearish rated fund for a while, and so our rating on the ETF has done a good job of flagging this downtrend, but we're at a key level now. And it's logical to think that the fund can bounce, i.e. rates can come in a bit. So we have to start to think about what does that mean for cyclical stocks in the near term? What does that mean for the growth stocks in the near term? It's safe to say, in my opinion, that some of those trends are extended in both directions. Something that I highlighted in my note today, which you can find at chaikinanalytics.com and sign up for a trial. The high beta versus low volatility ratio, which is a good proxy for the cyclical rotation trade. The high beta ETF has a lot of energy, a lot of financials in it. That has ripped to the upside, to the point now where it is about 2.6 standard deviations above its 200-day average. That is a level that over the past 5 years has kind of marked a near-term exhaustion point. So chasing the cyclical names doesn't make a ton of sense to me here. Now, we've been talking for a while about having a more balanced approach to asset allocation within equities. So within, not just growth and all growth all the time, taking a more balanced view. We've talked about that within the framework of participation and leadership is broadening. The question is, if you haven't moved yet, does now make the most sense? I don't think it does. Not with the treasury funds down on this key level. 10-year yield traded into resistance yesterday at around the 155.16 level, trading back under 1.5 this morning. The other metric that I look at as a measure for in an improving economy and therefore the cyclical rotation trade is the copper to gold ratio. That's extremely extended to the upside as well. RSI reading very overbought. That's playing out as yields, the inverse of those treasury prices, have traded into resistance as well. So I think we're at an inflection point here, at least for the near term, where it doesn't necessarily make sense to chase the cyclical trade if you're not already there. At the same time, it may not make sense to dump growth if you haven't already. Now, if you have a solid risk management process, you might have noticed over the course of the past couple of weeks that some triggers might have gotten you out of trades, depending on how risk averse you are and how tight those metrics are for you personally. That to me is a way to raise cash as prices are falling, such that you're in a position to put money to work when prices stabilize. So what I'm looking for here, and there's going to be a lot of information in today's trading, not so much a call, but information. I'm looking for treasuries to hold. I'm looking for IEF to hold current levels. At the same time, I'm looking for the high beta versus low volatility ratio to begin to stall. I'm looking for the copper to gold ratio to begin to stall. If those things happen, I wouldn't be surprised to see a little bit of a reversal of the rotation that's been playing out starting in September and really accelerating in November when we had the vaccine news. However, if that doesn't happen, if treasuries continue lower, if those ratios continue to expand to the upside, well, then there's information there as well. And we know that that rotation is ongoing and that the cyclical recovery trade has legs. Now, what I'm talking about here is very near-term phenomena, looking for stalling. It's more a function of don't chase than I think something's changing in that cyclical rotation trade. I continue to think having a balanced approach to equity allocations makes the most sense. I write about it today in my note. So I just wanted to flag some thoughts here. What's on my radar screen, what I'm going to be spending a good chunk of the day looking at, as well as the work that I do over the weekend. So happy Friday to everybody. I hope everybody has a great weekend. We'll be back next week with updated thoughts. Be well.